Hello, everyone. Today, we're going to explore a fascinating journey: how Bitcoin evolved from a niche experiment into a serious investment class. 7 years ago, in 2018, an influential white paper made a bold declaration. Bitcoin was ringing the bell for a new asset class. Back then, the total crypto market cap was just $10 billion. The criticism was fierce. How could such a small market even dream of competing with traditional asset classes, which are measured in trillions of dollars? Today, that same asset class has not only surpassed $300 billion, but has laid the foundation for a new financial pillar. This video is an analysis of that journey. We will examine the original framework, investability, economic profile, correlations, and risk-reward, and check in on what happened 7 years later. Investability. From niche to global liquidity, the first test for any new asset class is its investability. Is it liquid and accessible enough? In 2018, Bitcoin's daily trading volumes, which were already over $1 billion, were seen as a promising signal. However, the data was fragmented and the OTC market was opaque. Today, the landscape has radically changed. Trading volumes have multiplied, with Bitcoin alone trading tens of billions of dollars every day. The ecosystem has become professionalized. Regulated exchanges, futures on major platforms, ETFs, and institutional funds have made accessing Bitcoin easier and safer than ever. The question, is it liquid enough? Today has a resounding answer. Yes. The economic profile. Programmed scarcity in command. The core of Bitcoin's value lies in its unique monetary policy, a strictly limited and predictable supply, controlled by code, not a central bank. 7 years ago, there was lively debate about the upcoming halving, the event that would cut the issuance of new Bitcoins in half. Since then, we have witnessed not one, but two halvings. Today, Bitcoin's inflation rate has fallen well below 1%. The comparison to gold, often cited, now favors Bitcoin even more. While gold has a slightly inflationary supply each year, Bitcoin is intrinsically deflationary. This programmed scarcity has proven to be a fundamental pillar of its value, utility, and adoption. From talk to action, one of the hardest myths to kill 7 years ago was that Bitcoin was primarily used for illicit activities or pure speculation. Time and data have debunked this myth. The narrative has gone through three distinct phases. The pioneers, a period of early adopter adoption in gray markets, and finally the current era, dominated by legitimate enterprises and institutional use cases. The utility of the Bitcoin blockchain as a network for transferring value globally has exploded. Transaction volumes, the GDP of the network, have grown exponentially, supporting remittances, cross-border payments, and serving as a digital store of value for millions of people. And no, Bitcoin is not anonymous. It's pseudonymous and, in reality, much more traceable than cash. Correlation. The persistent diversification haven. Perhaps the most compelling argument 7 years ago was its low correlation with traditional asset classes. And today, this characteristic has proven not only durable but strengthened. Bitcoin has maintained a generally low correlation with stocks and bonds. In recent years, during peaks of geopolitical and macroeconomic uncertainty, it has often shown a negative correlation, behaving as an uncorrelated safe haven asset. In a world of increasingly interconnected financial markets, Bitcoin has established itself as one of the last true diversification tools. Risk and return. The maturing market volatility was the main obstacle cited by critics. While Bitcoin remains a volatile asset, its risk profile has softened significantly. The monumental increase in market liquidity and depth has smoothed out its most extreme swings. Today, its volatility is comparable to that of some high-growth tech stocks. The Sharpe ratio, which measures risk-adjusted returns, while no longer at the stratospheric levels of its origins, remains competitive, compensating investors for the risk taken within a diversified portfolio. Conclusion. The future is already here. So, where are we now? What was a $10 billion experiment has become the cornerstone of an alternative financial ecosystem worth hundreds of billions. Its fundamental characteristics: programmed scarcity, decentralization, low correlation, and global utility have not only held but have been cemented. Bitcoin hasn't replaced traditional asset classes, but it has carved out a unique and vital space, a new asset class native to the digital age. Looking at the future through the lens of Carlota Perez's model, we might only be at the beginning of a much larger adoption cycle. The journey from the white paper to reality has been extraordinary, and the next decade promises to be even more revolutionary. What do you think? Has Bitcoin exceeded your expectations over the last 7 years? Share your opinion in the comments. If you found this analysis useful, subscribe to the channel and hit the bell so you don't miss our next insights into the future of finance. See you next time.